Well, we're back once again. Let's do it.
No, this is a good episode. This is a good stuff. We're kind of like rounding out our survey of what makes markets move with Vanna.
I say Vanna, okay?
Vanna.
Only because I learned Vanna from Jim, and Jim references Vanna White, and she does not say Vanna, I'm pretty sure.
All right, totally fair. So
but I think Vanna is the correct one, but I'm not saying it.
Okay, yeah. Then anyway, for all those trolls out there, we're gonna do it, even if we don't know if it's.
I know somebody's gonna be in the comments or something. It's pronounced Vanna. They're gonna put the little, pronunciation next to it. We don't care.
All right, so the way that we were talking about it yesterday was actually pretty cool, and it's. By the way, this article that we're going to be looking at is called The Implied Order Book. It's like very well known at this point, but we read it so that you don't have to, and it's by Squeeze Metrics. So thanks to them for putting this out here. But the main idea is just that to identify what causes changes in delta, right? Because those are the deltas are what ultimately need to be hedged, because underlyings are delta, more or less, right? Like man.
So do we need to do a quick refresher on why delta is important?
Yeah, that's what I was thinking in the middle of saying that, as I was like, oh man.
Well, let's do it.
Yeah. So I think the easiest way to understand delta is, let's say that I buy a SPY option, then the delta of that SPY option is going to tell me my share equivalent. So if I wanted to replicate the performance of that option using shares, how many shares would I need to buy? And the thing is that options are complex instruments, they're convex. So the share equivalent of that option is not going to stay the same throughout movement in time, movement in price.
And so when you say convex, you're basically saying it's non-linear to the underlying. The prices they're not correlated linearly.
Yeah, exactly. So
okay, that's what the convexity means.
Yeah, it means that if you buy a 50 delta option, which is an at-the-money option, which is sort of going to behave equivalently to 50 shares of stock, if the underlying stock starts to move in your favor, that option is going to gradually start to behave more like 55 shares of stock, then 60, then 65, and then 70. And when I say it's going to behave that way, what I mean is that the price of your option is going to increase or decrease in a manner that is proportional to that many shares of stock.
And so that's the convexity that people are looking for when they're playing options, is instead of having to continually buy shares, you get to gain in that share value by using the options leverage, essentially. And it's taking advantage of this non-linearity.
Yeah, and I mean, not to get too in the weeds, but the reason that there is this non-linearity is because of the threshold of the strike price, right? Which is that if your call option is above the strike price, then it's going to pay out, and if it's underneath, it's not. And so the problem is, like, from a modeling perspective, like, how do we model the price of that option? That represents a significant uncertainty. So that's why if it's at the money, it's 50-50. So it's 50 delta, right? Because if it ends up working out, then you're going to get 100 shares of stock. And if it doesn't work out, then you won't. And if it's further than that, it'll get to a point where it's 60%. Of course, that's not exactly right mathematically, but like intuitively, that is the reason why these prices need to be. We need to model the share equivalent.
So it's perfect. Yeah. So perfectly. So and so we're going to focus on these, essentially one of these things, but these three things that affect the way those deltas move.
Yeah.
Speed they move, and essentially what ends up happening when the delta moves. What are the participants going to do about it?
Yes. So the assumption there is, okay, like let's assume that we have a market with just two participants, and it's me, John, and Vic, and let's say that I sold Vic a call option, right, and that call option starts to go against me. Vic is going to kind of want to know, or any other market participant is going to kind of want to know, how am I likely to adjust to that option moving against me? And in order to be able to know that, we have to know how that option is going to behave. So that's really the basis for all of this. And so I guess the real main point that is behind all of this, and Squeeze Metrics does this really nice. It's these three things, right? Like there's three main things that can change. Underlying price, so spot, sometimes I say spot, changes in time. I'm going to skip implied vol for now. We all know how time is going to change. That one's really obvious, so it's not very exciting. Underlying price, sorry about that. Underlying price, we don't know how it's going to change, so we can model it in various ways. And then implied volatility is going to essentially be the equivalent of how much supply or demand there is for the option, right? So like, for instance, if underlying price runs down like crazy, then all of a sudden people are going to really, really want options because prices are moving like crazy. And so implied vols are going to go up. There's going to be more demand for options because instead of going out and buying or selling shares, people are going to want to use the convexity of options. So yeah, those are the sort of the three main variables. And then we're going to have basically what we want to know is if those three things change, how are the deltas or how is the delta of an option going to change? And that's how we get to gamma, Vanna, and charm. Is that a fair?
Perfect. Yeah. So real quick here, because these graphs are great. So gamma, let's review what that is real quick. We'll do a quick effect on delta, what charm is here, because it's giving you a nice little graph here, and then we'll talk about Vanna.
Yeah. So gamma is going to be actually, Vic, why don't you do gamma since and then I'll do Vanna, and then we can get to charm.
Okay. Well, basically, I'm a simpleton, so we'll just follow what the chart is saying here. But essentially, you got this gamma curve. Okay, and depending on what the curve looks like, it's essentially telling you how fast this delta is going to move based on what spot does. Is that fair?
Yeah, no, that's exactly right. And it's
essentially how spot is moving up and down this curve. It's going to tell you, and you can see it there. You got a 50 delta. Spot moves down just a bit, it instantly becomes a 20 delta. That's the gamma effect on those deltas. So you got the 50, you got the 100 share position, and it instantly gets cut in essentially half. But it doesn't mean that your share position, if you had share position, it may have only gone down a couple bucks, right? So that's the gamma effect on the pricing of options, which is, I don't know, essentially an inefficiency in my opinion, probably in how either Black-Scholes model works or any other models you want to work, but that's basically what gamma is.
Yeah, I mean it's literally just the rate of change of delta. So we're saying how much is delta going to change given underlying price, and then that has to do with our certainty or uncertainty that this option is going to end up in the money, right? So the reason that 50 delta goes to a 20 delta so suddenly in this particular case is because if it was a 50 delta, right, it was right at the center of the distribution, meaning that the strike price was the same as the underlying price at that point in time. So we legitimately didn't know. The odds were kind of 50-50 at that point in time, whether it was going to go in the money or not. And then all of a sudden it didn't go in the money, right? And so now not only does spot price have to get back to where it previously was in order for that option to be worth anything, it has to go even further. So another way of thinking about it is now the distance that spot price has to travel in order to make that option worth anything is way further than it once was. And I mean, not to get ahead of ourselves, but there's way less time on the clock for it to do so, meaning that, it's less likely that lotto or whatever is going to hit.
So now sorry to cut you off there, but now we talk about, so why is gamma important when it comes to, say, hedging for it? And if you're looking at this chart and you're going, okay, well, you had this 50 delta and it just became a 20 delta, it was super fast because of the gamma effect. Well, you got to think about what's going to happen on the hedging side of that, right? So now folks are having to have a bigger hedging effect because the delta just got cut in half.
Yeah, and that can go both ways, right? Like if I bought that option and all of a sudden, like let's say that I want to maintain 50 shares of exposure to the underlying, I bought that option, all of a sudden I'm at 20 shares. Well, I'm going to have to buy 30 shares in a hurry to get myself back up to 50 shares. Or on the other side of things, let's say I sold that option and I want to stay short 50 shares. Then if all of a sudden that option is worth 20, I'm going to want to really quickly short another 30 shares to get myself back to where it was.
That's a good point. But, as far as what you're doing as the customer versus what the dealer is doing on the other side of things, if the dealer is short those calls that you're trying to, have a position in, all of a sudden he doesn't need 30 shares essentially. Right.
Yeah.
And so he's just going, I'm going to offload these 30 shares here because, now it's only a 20 delta. So who cares? And so those flows are what you're trying to really capture, because those are going to be, you might be a customer wanting the 50 delta, but are you really going to come in and reposition as just a retail trader? We're really trying to capture these dealer flows because those are going to be the more impactful flows.
Yeah, and the reality with the dealer is obviously a little more complicated than this, but let's assume that you're the dealer and I bought that 50 delta call. As soon as I bought it from you, you immediately hedged it with because you now sold. Yeah,
shorted 50 shares.
Opposite way around, right? If I bought it from you, then you sold a call, so you're short 50 deltas, meaning that you then got long 50 deltas to balance out your requirements.
There you go. Yeah, perfect.
So then if spot moves down, all of a sudden that call is only 20 deltas, and you were initially long 50. Well, now you only need to be long 20, so you can sell 30 of the ones that you were originally long, which is going to push price down even more. Because at the end of the day, that's what we care about, right? Like what shares are being transacted, because at the end of the day, that's what's going to be pushing price, it can be shares or futures, but it doesn't really matter, right? Like that's the underlying asset is the main price that we care. That's what we care about. Like, is it going to move? How much? How fast? When? But the thing is that the options are going to often dictate what transactions need to happen in the market for shares or futures or whatever, which is then going to end up moving the price, which is why we end up looking at these secondary markets in order to understand the primary markets, which yes is backwards, but welcome to the real world.
Yeah, and you got three pretty complicated, it's three-dimensional effect on delta here, and it's even more than that. But you're essentially just trying to get an idea of, the magnitude of the move, or who's off sides, and then if spot does this, this is going to be, this is going to cause sort of this, waterfall or cascading effect because of the positioning that was there for this spot, and then spot moves or IV moves, or we get to the expiration, and now those positions have to unwind. So it gives you a really good idea of potentially what could happen. So let's talk about charm in that sense, because I love charm.
Well, charm is nice because it's easier to understand, and it's just that this is what I was saying before, right? We all know how time is going to change, and we all know that, let's say your option's out of the money as it nears expiration, because there's less time on deck, there's less time for the underlying to move to all of a sudden make your option worth something, which means that naturally the value of your option should decrease. And so all that charm measures is instead of thinking about the value of your option versus time, right, which is what we usually call theta, it thinks about the deltas of your option versus time. So as time goes to zero, if your option remains out of the money, the deltas are also going to go to zero because that option is going to be the equivalent of 0 shares of stock because it's not going to be worth anything.
So you have essentially an exponential effect as you get nearer to the expiration, though, right? And so there's going to be a curve there that you have to account for.
Yeah, because it's one way to think about it is sort of in terms of a probability cone of expiry. So like, let's say that spot is currently trading at 100, then and like I want to know where spot is going to be trading at, a day from now. Maybe the possible move is it could move up to 110 or down to 90, but as that one day becomes 0 days, it no longer has any potential to move, and so the cone of possibilities, the distribution is shrinking, shrinking, shrinking. And if your option's on outside the cone, it's gone, it's dead.
Right, exactly. So all you're thinking about here is what is happening with the probability distribution in effect with time. And essentially there's a nonlinear correlation there as you get closer to the expiration. Which is why we talk about charm effect being stronger in certain windows of the OPEX cycles, because essentially what happens is that charm starts to hit those positions, whatever that be, whether the people all in calls or all in puts. And right now they're essentially, all in puts. So it'll become a thing here soon. But it's like as you get 3 or 5 days away, those positions, just by the fact that time is passing, is going to cause hedging effects, and it's going to be a daily thing. All of a sudden the dealer doesn't need all these deltas anymore for whatever reason, whether they're short or long, and it's going to cause an effect. So something you can pretty much know for a fact that's going to occur, unless something happens to put those positions back into play. And what I mean by that is they're back in the distribution again of probabilities. And charm won't have as much effect then, but it's still there. It's still something that's pretty concrete.
You said exactly what I was going to say, which is that the question kind of becomes who is going to be offsides by the time that expiration is around the corner, right?
Exactly. So one way to look at charm, the reason I like charm so much, like I said, it's just so easy to understand, and it's if you see the expiries and hey, 40% of OI is expiring on this day, and it's basically all puts, right? Like it's a 2 or 3 put call ratio, and you can see it in the OI that everybody's kind of bearish, but they got 2 days left to cash in on these. Otherwise, as time passes, it's just going to, the market makers, the dealers are just going to be continually doing what? Buying back their shorts. Because
they no longer have to hedge those options.
So you can have a bid in the market. Every time the market goes down, the market maker is going to use it as an opportunity to continue to offload his shorts and buy back the market. And so that's why I like charm a lot. And they all kind of work the same in a sense where it's either going to cause the dealers to have a buy in the market or a sell in the market in the form of like limit orders.
Yeah. And I mean, just for the sake of being thorough, right? If we were to move this strike price over here, then all of a sudden, and your options in the money, let's say, right? Then the charm effect is the opposite, right? Like it means that your deltas are actually going to go up as we reach expiry because the possibility of your option going out of the money is diminishing rapidly.
Yep.
It's basically all of these things are literally just all you have to do to understand most of the Greeks is just ask yourself the question, is the probability that the option is going to pay out increasing or decreasing?
And that's how the pricing is. That's what the pricing is driven to determine is probability of going in the money or out of the money. And so let's talk Vanna then, because Vanna is super popular, and I think it'll become even more popular soon just because the short vol regime and all of that. We can talk about that stuff, but
well, as soon as
it's still an effect in a lot of stuff.
Yeah, and well, I mean, it's part of the reason that we're rallying so hard. We've been rallying so hard, and it's okay. So actually, yeah, let's go back to that idea of the sort of the probability cone of expiry, which I always envision it kind of looking like this, right? It looks like a cone like that, and then let's say that you have prices squiggling around over here, and it's here, right? And so then like these are all the possible outcomes for price, right? It can either move up or down. And now take this little chart that you have in your brain and flip it so that it actually is this curve right here, right? And so you can see, right, if you have a bigger, flatter curve, it means more implied volatility. It means that there's a wider possible distribution of outcomes because things are more volatile, because this squiggly line, because spot price is moving a lot more. If it's narrower like this, it means that implied vol is lower. The possible distribution of outcomes is more narrow. We have a higher certainty as to where spot price is going to end up. I think that, oh yeah, he says it right here. A lower IV implies a narrower distribution. Sorry, I need to get rid of those things. They're kind of stupid.
So the implied vol, if you give it another name, is really just the market's expectation of the probability of outcomes.
Yes, that's a really good way to put it. And the funny connection and why maybe some of the time I'm a little confusing is because option prices are often quoted or talked about in terms of implied vols. So think about it like this. If there is a wider possible distribution of outcomes, then the prices of the out of the money options will be higher, because even if they're out of the money, the possibility of them going in the money is more possible. It's more likely. Whereas if we have a much narrower distribution, if implied volatility is low, then out of the money options will be cheaper because they're very unlikely to hit.
So here's something I read, and that's a good point. And here's something I read is the flatter the implied vol distribution, or what they call platycurtic, is essentially a market that is prepared for anything. And the likelihood of that thing happening is low.
Yes. Yeah.
And then if it's leptocurtic, so it kind of shows a leptocurtic version here with that kind of tall, skinnier distribution. And that's sort of what happens when IV shrinks as well. It's going to kind of shrink in, and it's going to put cut the IVs of those out of the monies, and it's going to lower the probability of your strike going into money. We'll talk about that. But that right there, a leptocurtic curve is essentially a risky market because it's not prepared for anything typically.
Well, yeah, and then the reason for that is because even though the vol will look like this, but well, actually, I mean, nowadays, since the 87 flash crash, this is kind of corrected, but the reality looks a little like this, right? It's those fat tails that you're talking about, right?
Well, people are a little bit more prepared on that's why you see the like if you look at a skew, it's a little bit left tail leaning, just because people are going to be hedged a little bit more, just in general. But yeah, you're right. I mean, the tails are going to be a little bit elevated just because people are always expecting that, just in case, right?
Yeah,
they got the just in case money out there, and so they're hedging those tails because it's cheap to do. It's cheap enough.
Yeah, I mean, sometimes it makes sense for your portfolio, regardless. I want to add something else because I think it's going to help for this whole thing, and it's I don't think it's too much of a mind fuck, but so we've made one connection. We've said that option prices can be talked about in terms of implied vol, right? So it's like a high implied vol means that options are more expensive. A low implied vol means that options are cheaper. I've also talked about it in terms of demand or supply for options, right? It's like if there's high demand and low supply, then we have high implied vol, and vice versa. Here's another connection, which is a little evil, but that is, and Squeeze Metrics pointed out right here. When implied vol God damn it. When implied vol moves down, the 20-day call becomes a 5-day call. And
delta.
so, well, okay. So here's the connection I'm going to make, actually. Yes, he is saying delta, but you could equivalently say day, right? Because you can either think in terms of static time and vol expanding or contracting, or you can think about vol staying static and time expanding and contracting.
So you're saying essentially the 20-day call would become a 5-day call in terms of price?
Yeah, essentially, if there's lower volatility, right, then it's almost as if time is being compressed.
I see. Okay.
Right. So
because the distribution plays across expiries as well. So if you're looking at like is that what you mean? Like if IV drops, as far as the term structure goes, then you might as well be the same thing as a 5-day call.
Yeah, exactly.
Gotcha.
In the same way, so like high implied volatility, we've talked about this before, right? Like in a high volatility environment, months can happen in days, right?
Yeah.
In a low implied volatility environment,
it's essentially the reverse.
Yes.
Yep. So when you look at the three things, and if you got more on Vanna, go ahead, but I'm going to kind of summarize it a little bit here. When you look at the three things, each thing is having an effect on delta, but each thing has its own probability distribution.
Yes.
Effectively. And so they're all kind of working in concert. But each has a different trigger. So time is a little bit slower. The implied vol, that's essentially going to widen the distribution or shrink it. And then the gamma is going to be essentially just based solely on spot. So depending on what type of trading you're doing, you have to know what the trigger is going to be.
Yes, I will add actually. So to complete that, right?
Mm-hmm. I know what you're going to say, I think, but let's see. It'll be good, I'm sure.
Gamma is going to move like up or down with spot, and it's also going to expand or shrink with changes in implied vol at the same time.
So those two are interconnected.
Yes.
Most of the time, because there's a correlation or negative correlation with spot. And sometimes a certain spot price will do what to implied volatility? Like if it goes below a certain area, then
yeah, that's true. If we get into the actual dynamics of watching the GEX charts, but like even before all of that, if spot price moves up or down, then the center of the gamma curve is going to be at wherever spot price is. But if IV increases, then the gamma curve is going to flatten out. And if IV decreases, then the gamma curve is going to get more pointy.
And why is that?
So the reason is this. If let's say we have an out of the money option, right? Let's say you have a 30 delta option, and IV increases. Then if it's out of the money, the deltas on the delta of your 30 delta option is actually going to go up as IV increases, because it's out of the money and the possibility that it'll end up in the money is increasing as well because there's more volatility. But if you have an in the money option, as IV is increasing, the possibility that your in the money option will become out of the money is also increasing, which is going to reduce the deltas. So on the gamma curve, if you're looking at it here, right, you can see that the 20 or the 30 delta is lower in gamma terms than the 50 delta. And similarly, so basically what it's going to do is it's going to elevate the IV of all of these guys out here, and it's going to lower the IV of everything that's nearer to the money, nearer to the center.
It's going to lower the delta, not the IV.
Sorry, I'm sorry. Yeah. It's
okay,
going to
just making sure.
It's going to lower the gamma. Lower the gamma.
Oh, reduces the gamma.
Mm-hmm. Because in a higher volatility environment, a move in spot even though it's very significant to the delta of your options, is less significant to the gamma because it could just as easily move back, right?
Gotcha.
Whereas
So,
in a lower volatility environment, a move in spot is really significant because if it moves forward, it's very unlikely to make it all the way back.
right. Okay. So they're interlinked, and there's a lot of nuances to it, essentially, where, if you figure out what, and I've seen, services like Gamma Edge, they really, really like to play off the in the monies.
Mm-hmm.
They're really, really watching, okay, what's the in the money call or in the money puts doing? And they're less concerned with what the out of the monies are doing for the most part. And I think it's sort of to what you're talking about here is, in some cases, the in the monies are what drive the flows.
Yeah, which is something that, it's a little hard to see sometimes because when the in the monies are fun in a way too, because that's, that's bigger money because they're more expensive.
Sure. Yeah. And they're, so if you can get, let's just say for a trade example, I had the other day was, I think it was like last Friday or the Friday before, a whole bunch of in the monies were expiring, and it caused sort of a cascading effect to happen into the end of the day, because as the, as it hit a certain strike that were a bunch of in the monies, you could just see it in the tape. Folks are just, basically just like, all right, screw it, I'm getting out. And so it caused a sort of a cascade, which is such a good word for it, because not only are the folks selling their in the money call, which is causing a selling pressure, the dealer is unwinding the hedge at the same time.
Yeah.
And nobody's buying, nobody's speculating calls because they were all having to unwind them. And so it's a cascade effect, right? It's like a triple whammy there. And so those are the moves I like to look for, is when when it kind of aligns to where it's like, okay, someone just, this whole section of the market just got caught, and you just got one or two strikes that get hit, and it's just boom, and then it's over.
And I mean, another way to think about that, right? And this is just the same language for, because the issue more broadly here, right, is we have a multi-dimensional problem, and we're always looking at it in sort of different two-dimensional ways. So in the same way, like everything that you just said, I could re-describe as just like call implied vols falling off because there's a lot of call supply and not much call demand.
Sure. Oh yeah, for sure. Yeah, and you can simplify it. I mean, as much as you want. And that, you're right. You could just say it in a more technical manner, I guess you could say. But that's what you're looking for when you're considering these three factors. And so it all sort of just centers around these I kind of like to think of the market as like, okay, what is the market's delta position in a way? And you don't know the exact, it's sort of naive, but it's good enough, for a retail trader, that's what I think.
You can definitely start to put it together. And so, yeah. And with respect to delta, each of these three variables is most predominantly influenced by each of these three things. But they are also influenced in secondary ways by each of the other things in this list.
Right. Yeah.
Just to make it awful for everybody, but that's
it does become like you said, it's sort of like our brains want to look at a price chart with just a moving average, and it becomes a whole nother ballgame when you're trying to think in this like 3-4 dimension and trying to account, and you don't have any kind of way of, for the most part, measuring it and looking at it. You know what I mean? And so it becomes a difficult way to trade, I would say.
Yeah, I think that's true. The upside is just that if you do understand this stuff, then you will seldom be surprised by what happens.
Yeah, you're a lot better prepared if you understand it for the day-to-day, week-to-week type of thing, especially rolling into expiries and understanding the OPEX cycle and that kind of thing, and it's sort of the whole dynamic. But it's definitely not for the faint of heart, I would say. And there's a lot of people out there that know this inside and out.
Yeah.
And so I would definitely, we here at the Bear Trap podcast, we are not, I would not say we're experts on it. When you think of true experts, I would say we're not there. Like a Jim Carson, if he was in here talking about this, he's a pure expert, right? Or like Wizard of Ops or something like that, or like Ock would be pure expert. But my point here is that it's good enough to understand the basics of it.
Yeah, just so that you're not asking yourself what happened. And of course, like there all are these heuristics that make it a lot easier. Like we can, all the other stuff that I said aside, we can just think about the simple question of, do these guys expand, contract, or shift the distribution of probabilities, right? And gamma shifts it, like it shifts with spot. Vanna like tells you that the distribution expands with implied vol and shrinks when implied vol contracts. And charm tells you that the distribution shrinks over time. It's that simple.
Yep, and that was the whole point of what I was trying to say was it's really and you can trade any one of these distributions, and that's what they are. They all play off each other. They all create a holistic distribution, but you can play each one separately.
Yeah, you
can play just the IV if you want, or you could play just the charm factor or the gamma factor. You don't have to. It's like someone picking like, hey, I want to use the MACD, or I want to use just the SMA or whatever. I'm going to do ICT concepts. So, all right, let's see. Is there anything else we can talk about in here that?
Oh yeah, man. We're just way at the beginning.
That's fine.
But no, actually, I think I'm just going to skip us to, the one other thing I really wanted to talk about, which is that here, let's find this. Which is this central concept, which is, I think, something that like a lot of people are missing, and a lot of people in the bear trap are also missing.
Okay.
And this is what we were talking about yesterday too. And it's just this statement: when implied volatilities go up, gammas and this gex move towards zero. Right. And that's what I was talking about, where if implied vols go up, as you know, the distribution flattens out. And if the distribution flattens out, then the delta effects of any particular move start to become less significant.
It moves towards zero, like it moves towards the zero gamma area. What does it mean that it moves towards zero?
So if this is your gamma curve, right? Or like this is your first gamma curve, right? Which is kind of it has this like little peak and whatever. As IV moves up, the whole curve flattens like this. So gotcha. Gamma exposure in general actually
it's moving towards zero. Gotcha.
Yes, exactly. Yep. Yeah.
So it makes sense. So the effect of gamma on the deltas is actually going to shrink because the curve is flattening.
Mm-hmm. Exactly.
Makes perfect sense. Okay.
Okay, so now that we've got that, we can start to move on.
So if you have a high IV environment, you're expecting IV. I'm just going to relate this to trading. If you're expecting IV to go up, and you're looking at a high gamma environment, whether negative or positive, it's not going to matter as much when IV is going up. So if you're playing the gamma of a market, you want the IV to be going down effectively.
Yeah, actually you do.
Okay.
So, I mean, yeah, and that's something really important for people to keep in mind. And the other thing is, this classification that we often use between, a negative GEX or a positive GEX regime. Granted, right, like your distribution of outcomes is going to be really different in terms of market price action if you're in a negative gamma versus a positive gamma regime. Exposure regime. But the reason I don't really like the classifications is that if you are in a negative GEX regime, the possibility of you returning into a positive one is actually pretty high, because there's just so much, like, that's the whole point. It's like vol is going to move up, which is going to mean that gamma is less important, which is going to mean that if you're in a negative gamma regime, the fact that you're in a negative gamma regime is actually less important, if that makes sense.
It does. It does make a lot of sense. But how would that? So the negative Gex environment's not that important because IV is rising. But why does that say you're more likely to return to a positive gamma?
Simply because the distribution of outcomes is flatter. It's like wider. So like we're just going to jump around like crazy is all that's going to happen. And then the likelihood that one of those jumps takes us back into positive, which then generates a feedback loop, which keeps us in positive, is quite likely.
So that's why we always see the market sort of, for some crazy reason, return back into, this vol compression, negative, positive Gex environment. It just naturally created to do that.
Yep.
Makes sense.
Yeah. And so the reason that getting into Vanna exposure is important is because so let's say that we're selling off, right? And if we're selling off, then implied vol is moving up. So when we're in the first part of this table over here. So let's say that a lot of people are long out of the money puts. So if they're long out of the money puts, then we're going to be over here. And let's say that customers are long out of the money puts. Okay, so spot moves down, implied vols move up, and that means that dealers are going to sell. So they're going to lean into the selling.
It makes sense because the put deltas are going up, and they're having to short more shares.
Yes.
But if IV is going up, the put deltas, they're going to hit a crescendo, I guess you could say. There's going to be a limit there because, the gamma is shrinking, there's flattening out.
You got it.
So there is an extreme inflection point that's about to be hit on this gamma curve with respect to the deltas, and that's probably why you see the V shapes happen a lot, huh?
Exactly. That's why you see V shapes. It's because at some point the implied vol is so high that the change in delta as spot moves down is not particularly significant. So dealers aren't selling anymore. So the only and then as people notice that dealer flows aren't also coming in to sell, people start to liquidate their puts, and then all of a sudden we get positive delta flows. But even aside from that, let's say that nobody were to liquidate their puts, right? What's going to happen is because IV is very high, even if spot moves down, IV isn't moving much higher, and gamma isn't particularly high at all, meaning that we don't get that many more negative deltas. So we just end up stuck. There's literally nothing to do. So that's why sometimes you see a V shape. Sometimes you also just see literally sideways action. And then at some point, there's just absolute exhaustion, because what's happening during that sideways action is basically more people are adding more out of the money puts. And as soon as that adding stops, we start to rally again because dealers aren't adding any negative deltas.
So once you get to this point, this inflection point on this curve, the next thing you're looking for is whether or not folks are going to continue to buy out of the monies and essentially cause IV to continue going up.
Yes, you are entirely reliant on more demand coming into the market for long out of the money put protection. And if
go ahead.
No, if more demand doesn't come in, then naturally we are going to move up. There's just nothing to do.
Yeah, well, then you're dependent on what IV does, which is dependent on the demand. But if IV doesn't come down, then you're not necessarily, like you said, you're not going to do anything. But if IV does come down, that's going to cause that gamma curve to go back up again. And so that's going to cause the delta effect on those puts to accelerate.
Yeah, but what you would need to happen is essentially, that's why sells have legs, right? What you would need to have happen is implied vol would need to come back down, then people would need to add out of the money puts, and then we could sell again. Basically, you need to reset the system, so to speak.
So you're either waiting for the reset, looking for more participation to the downside, and essentially what you're hoping for is you don't hit that inflection point on that gamma curve.
Mm-hmm. Yeah.
So you're just watching that kind of either acceleration to the upside, or if folks are buying calls, that would cause an issue.
Yeah. To put it in terms of rates of change, the demand for puts has to exceed the reduction in gamma.
Gamma. Yep. The reduction in so I wonder, is there a measurement for the reduction in gamma?
Yeah, absolutely. Yeah, we can.
What is it?
Well,
says IV goes up. What's the correlation with how much gamma flattens?
I don't remember the precise name of it.
There is a Greek for it, though, isn't there? There is a second order Greek for it. Okay, or third order Greek, I guess.
It's so gamma is speed, color, and I forget what the other one is. I'm just looking it up.
Gotcha. Okay, cool. I was just curious if there was, because I'd never gotten that deep into the rabbit hole. So
it's actually Zama.
Zama. Okay, I've heard of Zama. Okay.
Yeah. So
I'm sure someone else is out there like, oh, you didn't know what Zama was. Well, yeah, I don't really care that much.
Dude, no one uses it. I got.
If you're using Zama, then you don't need to be listening to this podcast. Okay. Basically.
Hey, I was right about speed and color.
No, I'm saying, but if you're using it, hey, you should be on.
I mean, after this podcast, man, I'm gonna start to use Zama.
But that's such a cool concept. Is if you can know the rate at which gamma is going to flatten, that's also kind of interesting. I don't know how it would play in to how we trade, how the normal, because I'm looking for the flush, and then I'm in and out. I don't really.
Well, I'm about to tell you what's going to generate the big boy flush.
Okay.
That's where we're headed.
Okay.
With this one.
All right. So this is the highlight. All right.
Yeah. That's the goal. No, but the other thing I want to mention is, like, if you did want to use Zama, right? We're talking about relative rates of change here, so you'd have to monitor order flow and then also think about Zama at the same time.
Okay.
Hello?
So yeah.
Oh, okay. Yeah.
No, that is fascinating. So, all right, yeah, get us to the home plate.
You were like, man, I don't even care, but let's get to what's going to cause the big sell.
No, I mean, I kind of already know what causes the big sell, but people want to hear that.
Yeah, I know, that's fair. It's these guys right here. The customer short in the money puts.
Yeah, and so naturally you can be pretty simple here, but break it down from the IV and gamma respect.
Yeah, so we said that, customer long out of the money puts, that's fine. We can have a pretty big sell-off or a sell-off of some kind, but at some point vol's so high that it just can't, that the gamma goes down, that dealers don't need to hedge anymore. But what happens with when customers are short in the money puts is that dealers have bought those in the money puts, basically, right? Because customers are short, which means that dealers are long delta. And this goes back to the scenario that we originally talked about. What'll happen is, if IV keeps going up, then the deltas of those in the money puts actually start to come down, which means that the dealers aren't as protected as they thought that they were, which means that they have to short more. So it generates this feedback loop where implied vol can continue to move up, and the more it moves up, the more dealers have to sell. So that's the real distinction here, right? If customers are just long put protection, then if
the gamma curve doesn't matter as much.
Or it actually, so it matters in the opposite way, right? The fact that the gamma curve is flattening is causing the dealer to sell more.
Oh, that's interesting. Yeah, you're right. Yeah, because the rate, it's actually causing the deltas to change on the outer edges.
Yes, exactly.
Yeah.
So it's the deep in the money puts whose deltas are decreasing, which means that all of the protection that the dealers had is no longer as protected because implied vol is so high.
Yeah, makes sense. It makes sense. So you got a double whammy there too, because the implied vol is already going to cause those delta changes on the edges, essentially bringing those puts into play for a price movement, and then you've got the gamma effect on them, and then the fact that you got the dealer flow going against you. As folks are going to have to essentially start buying their puts back, so you got the cascading effect again, where the customer's having to buy the put, the dealer's having a short, and until it reaches the inflection point again, to where everybody's kind of been destroyed.
Yeah,
it's just my favorite part of the market. Golly, I love it.
Exactly. That's
sick freak, but
essentially this is like a feedback loop at first, right? Which then reaches a limit because it starts to undermine itself, so to speak. But this one potentially has no end. That's the difference.
And so let's relate this to the current environment right now, real quick, before we move on to if we have another thing. Folks are very short vol right now.
Yeah, you read my mind. That was the next topic of conversation. Yep.
Okay, perfect. So customers are very short. Yeah, and this could work both ways, right? Because folks are, I think, short calls too.
Well, oh man, I'd have to think about that one.
Think about that one. Like if let's go to this scenario here where customer is short out of the money call up here at the top.
So I don't think so, actually, because usually if price moves up, implied vol comes down, which means that if customers are short in
dealer
the money,
buys.
No, customers short in the money call.
In the money, dealer sells. If they're short out of the money, dealer buys.
Yeah. So it's not the same dynamic, actually.
It's not the same dynamic in speed, right?
In Zama.
In Zama. Yeah, there you go. In Zama. Well, okay, so in this case here, it's saying that the gamma curve does the opposite thing. When implied vol goes down, it's actually going to go more leptokurtic. It's gonna,
correct. Yep.
But it's going to create the gamma acceleration effect, which means that the upside would actually is more likely to cause a cascading effect to the upside.
Well, so if customers are short out of the money calls, then yes. But as soon as those short calls go in the money, then no.
And then it reaches a crescendo there.
Yes,
the dealers are selling once they're in the money.
Yeah, if implied vol comes down and the market's moving up, then our relationship flips where, right, because we were distinguishing between the sort of the feedback loop, which is like the death spiral, I think. Let's call it the death spiral, and the just like the normal sell, right? And so in this particular case, you don't get a death spiral to the upside with these short in the monies. It's more so the short out of the monies that are a problem in terms of causing a gamma squeeze, so to speak.
Makes sense.
Yes, I guess the question is the difference here too is that if customers are long in the money calls, like so. The gamma and Vanna squeezes to the upside are caused by these two central categories: customers being short out of the money calls and customers being long in the money calls.
Mm-hmm.
Both of these cause the dealer to buy. But
because
these two
as
categories
implied vol goes down, it's causing that gamma curve to shrink.
Correct. Yep.
To the middle. Got it. Yeah.
So, and in this case, right, when we're looking at this, we don't have to think about Vanna as much because it becomes more of a gamma regime, right? Like gamma's very strong, it matters a lot, and we can look at we should mainly be looking at calls as like motivators in this particular context.
Right. Yep. It makes sense. So yeah, look at this customer out of the money call. And as an IV goes down, their dealer is selling. And that's because those positions are getting killed by that gamma. I guess you could call it what is that, a gamma contraction?
Sorry, are you saying this one, the customer long out of the money call? Oh, yeah.
So what is it when this gamma distribution is shrinking to the middle effectively?
Let me just highlight this one so that everyone can see which one we're talking about. This guy right now. So if implied vol is contracting, then it means that the distribution of probabilities is also contracting, which if your call is in the money means it's losing value. I guess that would be, whatever that would be, like negative Zama or something, probably.
Negative Zama. Right. Okay. Well, yeah. All right. So basically, when you're coming into the market, you want to know, like, if you're playing 0DTE or whatever, or you're playing for a big expiry, what is the customer's positioning by and large, right?
Usually it's customers who are being long these calls.
Well, yeah. So you can basically that's your goal, is to figure out what the customer is positioned by and large. And then you go to IV and you go, okay, what's IV doing? Essentially, if it's coming down and the positioning, then you know what the dealer's going to do.
Yeah. Sorry, I didn't realize where you were going with that. Yeah. So
applying it to trading is what I'm trying to do.
The typical assumption is that actually it's kind of the opposite of what I said. It's that customers have a tendency to buy puts and sell calls, which is why the market usually, or part of why the market usually moves up. And the reason for that is because customers have a tendency to have large portfolios which are full of stock, and you want to buy put protection to protect your portfolio. And then at the same time, you want to sell out of the money calls because that way you can harvest a little bit of premium. It's essentially just covered call selling. So that's like the typical environment, typical assumption. Right now, and this is why it's kind of important to be monitoring this stuff, we're in an environment in which selling premium has become a very significant source of yield, which is something that we covered when we did our episode on the Ambrus 0DTE paper. So, shout out to that if you guys haven't watched that already. But now basically people are selling all over the place. They're selling everything, which is why if we do end up getting a little bit of a surprise sell-off, we are in a very, and this is something that Jem is saying, on Top Traders, and this is literally why. It's because if customers are so confident in the market and the fact that volatility is going to contract, that they continue to sell puts, and they're selling more puts than they can afford to sell, and then all of a sudden those puts go in the money, the customers don't necessarily want or need to get out of that position because it's already in the money. In other words, it already has diminishing convexity. But for the dealer, as long as vol continues to increase, it creates a feedback loop which can end in a death spiral of some kind. So essentially, as the market continues to trend up, so long as people continue to sell vol, if we do finally get a surprise, which is it would have to be a gap down, a substantial gap down, which makes for a lot of in the money puts and a rise in vol. Maybe it'll have to happen over some time because vol will already have to be pretty near to an extreme.
Maybe tomorrow.
Yeah, not tomorrow.
You see futures right now?
What? No.
Oh, it's only down 10.
10 points?
Far. Yeah, it's only down 10. But when's the last time the market has been down 10 points? It's been very rare. Very, very rare for a long time.
That's fair. Anyway, thank you for allowing me to monologue for a little bit, but you get my
You're
point,
welcome.
right? Like, it's
I do.
Yeah.
Yeah, and that's what I was saying earlier too. Is everybody is crowded into this. As soon as you start hearing about it, that's when the bubble's about to pop. As soon as FinTwit's talking about it, they're making articles about it. Oh my gosh, it's the short vol regime. People, I think I saw some article about a record selling of premium.
Yeah. I mean, Chris Siddall has been talking about it on Twitter. I was trying to pull up that tweet. I don't know where the hell I put it, but it's somewhere.
Was that who posted the record selling chart? Which is it's something that's interesting. If you've been trading for a while, you always get these records that get broken, and a lot of times it's like record put buying or record call buying, but I haven't heard record premium selling. I haven't heard that one yet in about 5 years of trading. That's the first time I heard that. And I'm sure people back in 2017, I think that's when you had a similar sort of regime. Or was it 2016? I don't know. But
no, 17 is right.
17.
Yeah, I'm pulling up the tweet. Oh, here we go. I found it. Nice.
So you got a situation where the market is a tinderbox ready to just get obliterated in one way or the other. And it's most likely to the downside, given where price is right now, where we're trading. But that's why I was talking about NVIDIA to you last night. And folks that are listening out there, we were trying to brainstorm on how to do this podcast. And I wanted to bring in the NVIDIA situation into it because it's something that Jim talked about on Top Traders podcast was, these vol centers. Everybody's short vol in the S&Ps. But there's no vol, there's no more vol to short there, so they go to these other major stocks, and you got record call buying in NVIDIA, you get tons of call buying in Apple, and these huge mega caps, and so they become a source for short vol.
Okay, this is what we're talking about. A SIBO index tracking the 3-month implied correlation among slumped into
Can you post it in the screen here because I can't see it.
Oh, you can't see it. Oh, I totally. Oops. Give me 1 second.
Minimize that, puppy.
Switch screen or window. Boom.
There you go. Perfect. Yes.
The net amount of selling broke a record in April and did so again in June, according to Morgan Stanley's team. Yeah, and so people are starting to highlight this. Like we're looking at a crazy amount of vol selling, which, to be fair, has been an excellent trade.
Right. And so it's, what's been working, people think is going to continue working into the future. It's a fallacy, and they crowd into it because it's the only thing that seems to be working, either being long equity, being long tech, or being short vol, or both. It's essentially putting everybody, not everybody, there's quite a few bears out there still, but putting everybody on the same side of the boat in a really bad way. Yeah. Because not only are you on the side of the boat, you're on the side of the boat and you're about to walk the plank, and you're on the planks as well, and you're naked and you're about to go into shark infested waters, bear infested waters. That's what's happening right now, in my opinion. Now, I'm only a 5-year trader, so my opinion is not really worth much, and I've never been in the regime, but it's, if we're all the dynamics that we talked about so far, if we talk about cascading effects, this is the mother lode, effectively. This is the mother of situations.
Well, that's why, a buddy of mine, I told him, hey, yeah, I've been in cash since last year, and he's like, well, the S&P is closer to the all-time high than it is to even the most recent dip, right? And I'm like, yeah, I know, it's fine.
You're not willing to risk any money, really, it sounds like, because until this breaks, until it pops.
And part of it's because I don't know, right? It's at least I have not been short. I've not been short at all, right? Because I'm not that stupid, I guess. Not stupid, but eager. But at the same time, I'm concerned.
So, what in your opinion, professional opinion, what triggers? Is it going to be a catalyst of some sort, or is it a time effect? I think Jem referenced it's going to be the passing of time, or some sort of unpinning of VIX or of vol. Which
Well,
he doesn't
actually,
use VIX, he
you
uses
know
fixed
what?
strike vol, but
Yeah, let's go back. Actually, that's a good question. Let's go right back to the Vanna chart because that's also significant to answer this. Switch action or window. Okay, let's get back over here. So, as long as customers continue to be long these out of the money puts, and I mean this is something that you know intuitively. It's this guy down here, this category. Let me draw a little arrow.
here's something I want to talk about though real quick. I look at these put call ratios all the time, and the put call ratio could be people are just short puts, right?
Sure.
And I'm starting to think that that's the case.
Yeah. If you see extreme put call ratios right now, that's probably what that is.
Folks are actually short the put, and that explains what.
But again, it's a matter of how many.
It's significant. It's a lot, but I'll have to look at it in some more detail at some point. But yeah, keep going. Sorry.
No, the only thing I was gonna say is that in the same way as there's that potential for the death spiral, until that happens, we're actually, so to speak, spiraling the other way because if implied volatility comes down, then so dealers are buying as implied volatility is coming down. Dealers are buying whenever customers are short out of the money calls. Whenever customers are long in the money calls, whenever customers are short in the money puts, and whenever customers are long out of the money puts. So all these four combinations, right?
It's going to cause it to go up still.
Yes, to go exactly. Yep. Those center four, and the reality is, because we're up. Like a lot of people are holding on to long in the money calls right now. And I don't know so much about this. Short in the money puts, I'd imagine there's some of them out there because, it makes sense. Like it's essentially just like a long stock equivalent at that point. But mostly it's customers being short calls and long puts. That's the brunt of it. It's these two on the diagonal.
Well, that could be the case, but what the trigger event that you're looking for is for this implied vol down section to become implied vol up.
Yeah.
Yes. But you would need that for the supercell. You would need the customer to be short in the money put.
Mm-hmm. Yeah.
Because so it's a really narrow window here that you would need customer to be short in the money put and for implied vol to rip to cause significant damage. Any other scenario, there's just so many reasons for them to buy, for the dealer to be a buyer.
Yeah, and I mean the dynamic that could lead to a blow off top is actually something like this, is like customers being short in the money calls.
Mm-hmm.
God damn, I hate that feature. But because I mean, and I hadn't really been thinking about this too much before, but let's say that, yeah, actually, I mean, we've seen that happen before with I remember just like an SPX AM expiry where that happened. And this is what you were talking about before, right? Where it's like you're short in the money calls, we're nearing expiry, and so all those calls are coming off the book, so call demand is going down like crazy, and then that's what would get us the first leg of a sell.
So if they're short in the money call, you're saying that would lead to a blow-off situation. if customer is short.
No, it's like not that it would lead to a blow off situation. It's the second part of the blow off. So like if spot runs up like crazy and then all of a sudden a ton of customers are short and the money calls, then we get sustained dealer selling even with implied vol down.
Gotcha. Yeah, makes sense.
But anyway, I think at that point, at that point, I'm just like racking my brain and trying to figure out how this is all going to start to unravel. The reality is, like you said, it's likelier that we need a sort of implied vol. We need a first leg down, which is going to raise implied vol. Then we're going to stall. Then people are going to think that everything's okay again. Then they're going to go back to selling premium. And then after we get a second leg down, that's when we can get a real death spiral.
I think that happened Friday, but we'll see.
Really? Already?
I think folks, they're all into the short vol thing. I think they're already trying to they sold puts into the weekend on that dive. I think folks are going to be short puts tomorrow.
Well, I mean, you've been following price action more than I have, so
true. But that's just a gut feeling. I actually need to look at OI in the morning and see if that is the case, and if my assumption is correct. But just knowing what I've been reading about and how folks are just so desperate for yield, and they for some reason don't want to put their money in treasuries, instead they want to buy stock. I think they're just going, yeah, screw it. I'm just going to sell puts. Any kind of IV spike. I mean, we saw it the other day when it hit VIX hit 17 and it dropped back to 15 within a couple hours.
That's actually a good point, because that was a pretty significant spike that got faded.
It got faded. So people were just like, okay, well, I'm selling all my puts that were dying, and then I'm just going to sell more puts because short vol for the win. And it worked again if you were short term. Then again, we get another sell, okay, which didn't do anything to VIX if you were watching it.
Yeah, I did actually, and I was very interested in how that happened because
yeah. So you had a huge monster reversal with nothing happening on the VIX.
I will say I was also monitoring 0 DTE, 1 DTE, 2 DTE falls. Almost nothing.
Yeah. And so that's interesting. I'm not sure how to read that personally. The way I read it, I'm not sure if it's correct, is that folks were selling puts into the fall because it wasn't causing any kind of put demand to spike the VIX. People were
or at least there was equilibrium, right?
Right. They were covering their puts or they were selling puts. But it wasn't causing, and it's a 30-day measurement. So, the next 30 days, they weren't doing anything significant as far as hedging.
But I'm telling you, man, like even the next, I mean, you can look at the VIX 9D or the VIX 1D or whatever. If you were,
I did. They were not moving that much either.
Exactly.
And so I think folks are going, this is a sell, but it's a perfect opportunity to get long or to sell more puts, which it may be, and I could just be reading it wrong, but I'm pretty sure that their short put customer is into an implied vol situation where the VIX kind of got unpinned on Thursday or Wednesday with the spike up, and so it could be a situation where you may get that first leg soon.
I mean, I hope so, but
I hope so too. I don't really hope that much, but it's one of those situations where
also when we say that we hope so, we're not saying that we want people to lose money. What we are saying is that it would be nice to see something valued fairly for once.
I want a new regime is what I want. I don't like the short vol regime. It's too tinderboxy, man. I don't like the fact that you could all it takes is one major sell and you blow your account. You know what I mean? Just for a few bucks in premium. I don't like that. But here's the thing: is like Jim was talking about on the Top Traders podcast again, which I highly recommend for everyone to read or to listen to. But he was saying a 7% down day is likely to lead to a 20% down day.
Yeah, that's exactly what I'm saying with this. Yeah, exactly. A 7% down day is precisely what catches, uh, put sellers. All of a sudden, they have the in the money puts, implied vol continues to rise, and then we get the spiral. And the thing is that 20% down day, he doesn't say this, but it's not like the next day isn't another 20% down day, right? Like
It very
he
well
doesn't
could be.
he doesn't get into it, but given these dynamics, it's quite probable.
Yeah. And that's another reason. It is 100% of the time these short vol regimes get blown up. And it doesn't mean everybody gets blown up, but if you stick around too long, it always ends up happening, right? It always
This doesn't mean that you should go out and buy puts.
No, not financial advice.
That is most definitely going to also get you blown up, right?
For sure. Though I did buy some puts at the end of the day on Friday, because that exact theory that I have was that folks are going to be selling puts to me, hoping that they can catch premium. Dude, you could buy the 435 SPY put even on the very low of the day was only for like $20. And it was only three points out of the money. And I was just going, and that's where I was looking at the VIX going, people are they're just shorting this, aren't they? They're not buying this. They're not buying these.
Well, and I love how as soon as you get back into the trader talk, we see that element come out where, you're talking about implied vols, you're talking about distribution, you're talking about option price, you're talking about supply and demand, and you intuitively understand that they're all the same thing.
Correct. Yeah. They are. Yeah. And your goal, if anybody's still listening at this point, how long have we been going?
A little over an hour.
I'm sure you'll break this up into sections, but if anybody's still listening, your whole goal is to try and synthesize all this into a trading strategy, that has edge to it. It's so easy to build edge when you understand this stuff. And because you already have the edges are right there for you, right? You got the distribution, and then you literally have the market's expectation for movement, and you have the edges of those movements, right? So you've got built-in edge already by the understanding of this, and the fact that literally probably only 5% of the people trade with this stuff.
Yeah, no, I agree with you that is true. Figuring out, like, having and finding edge is not too hard. Not being an idiot is hard.